We're back. The seventh step of the accounting cycle. Remember the first six. Collect and verify your source documents. Analyze the transactions or transaction. Journalize, post, prepare a trial balance, and then the previous chapter before I left was to prepare a worksheet, the working paper that's going to be used now to prepare our financial statements. And we basically have done this already. We've practiced it and practiced it, but you know what? It's good to keep practicing to make sure you understand how to do it. And the statements that we're going to come up with, they're basically going to tell us how the business is doing, you know, based on the transactions that had happened during the period. So we're going to see how healthy is the business. Obviously, your investors want to know that. Owners want to know it. How are we doing for that particular period? We can compare amounts from previous periods to see maybe we have to make different decisions based on what's happening. But what we're going to do again is the income statement, the balance sheet, and the statement of changes in owner's equity, which we've already done. Now, once again, the income statement is going to tell us again whether or not we made money or lost money. So it would be described as having a net income or net loss for that fiscal period. It's also called the profit and loss statement or the earnings statement. Now we're going to do. Alrighty then. Sometimes, it's always prepared in ink. If we were doing it manually, you're going to use the computer. But once again, remember the heading, the name of the company, the name of the statement, and then for the month ended and whatever month and whatever the year is that you're doing it. Remember to do this again. We're centering it. It's going to look perfect. No spelling errors. Notice that the F, the M, the E, and the various letters are capitalized, not all lowercase. We're not going to write 2000 dash dash. We're going to write 2016, 2017, depending on what year we're doing this for. Now, the income statement, once again, remember we're doing it for sole proprietorship, one owner. And then we will do a statement of changes in owner's equity, but we'll do that after we do the income statement. And once again, you've done it before. Once again, just a quick review. You have the name of the company, the name of the statement, and then the period of time, when. In this case here, we have more than one revenue, so if you notice the accounts, the balances are listed in column 1, and a single underline, because we are going to add these three amounts and put the total in column 2 here on the right side. So revenues is pluralized, followed by a colon, since we have more than one revenue account listed. If it was just one revenue account, let's just say wash revenue, then we would just carry this number over to the column 2 since there is only one, and we would not have to write total revenues since there would be only one. Next section. Our expenses, followed by a colon. All the expenses are listed. Once again, all this information is taken right out of the worksheet, the income statement section. The underline here, ruling, because we're going to add up all these amounts, and the total is listed on the right side. If you notice, these are indented. The revenue is indented. All the expenses are indented. And total expenses will be indented from the expenses that are listed. In this case, our revenue is greater than our expenses, therefore we had a net income. And this information must match the information coming off the worksheet. If it does, we have a double underline. There are no mistakes. You did a perfect job, which is what I expect. Now once again, just remember, this is not debit. The column 1 and column 2 is not debits or credits. If there's more than one amount, it's listed on the left side of column 1. One amount based on the section was listed on the right side. In this case, once again, name of the company, income statement, and then our what is it for the month ended. In this case, we only have one revenue account, so revenue singular followed by a colon, indented, the name of the account, and the amount, the balance is listed on the right-hand side. Then we have the expense section followed by the colon. All the expenses are indented. Their amounts are listed. Total expenses indented from the expense section. Single underline because we're adding up these numbers. The total, once again, on the right-hand side, column 2, followed by a single underline. And then, once again, our revenue is greater than our expenses, therefore we do have a net income. In this case, this amount has to be on the worksheet, has to be exactly the same, followed by a double underline, meaning that we've completed this particular financial statement. We can also have, if you look now on the bottom, it doesn't have to be just for the month ended, it could be for the quarter ended or the fiscal year ended. It all is based on your particular company, and these are just different names. The income statement's also called the earnings statement and the profit and loss statement. Now, if we had a net loss, this is what we would do. Once again, same thing, name of the company, statement, when it's for. In this case, we have more than one revenue, so those amounts are listed in column 1. We have the 2 revenue amounts, single underline, total put on the right-hand side. Don't forget the colon, don't forget to indent. Then we have all our expenses listed, all on the column 1. Single underline, total expenses listed on the right. In this case, our expenses are greater than our revenue, therefore we have a net loss. So we just subtract and put the amount here, and this also has to match the numbers on the worksheet. What you can do, you could put parentheses around it, but it really doesn't matter because we know it's a net loss. That's what you've listed on the left-hand side. So this is an example of what it looks like if there was a net loss. Now, the statement of changes in owner's equity, again, what we have to do, we have to find what the actual balance is in the capital account at that time when we are doing our financial statements. We want to know whether or not the owner's equity has gone up or has gone down. Also, we want to know whether or not there were any investments by the owner during that period of time. So, and remember, the amount, whatever we find at the end, what the actual capital balance will be, that information will be transferred to the balance sheet for the capital balance. When we find the information in the worksheet, the income statement, and the capital account in the ledger, we can look to see whether or not the owner made any investments during that time period. So once again, we've done this before, name of the company, name of the statement, when is it for the month ended. Just have to memorize this. Beginning capital on the first date, the first of the month, on the column 2. Were there any investments? If there was, and in net income, we have 2 numbers, so we have to add them. So there's a single underline. Once again, if there was no investments, we would just put the net income here and then add and put the number for the total on the right-hand side. But since we have 2 things that we're going to add, we list it in column 1, followed by the single underline. Our total increase in capital goes here, which are these 2 numbers added. Our subtotal would be our beginning capital plus our increase. Obviously, if the owner invests money, if there's a net income, the amount of equity we have increases. Then we have to look again, in this case, the worksheet, and find out our withdrawals, $700. We're doing some math here, single underline. So our ending capital at the end of the month would be this, and we have a double underline. And you have to remember, this amount is transferred to the balance sheet. This is what students forget time after time after time. That's why their accounting equation doesn't balance in the balance sheet, because they forget to transfer this number. They want students to transfer the number they see in the worksheet, which is incorrect. That's why we're doing the statement of changes in owner's equity, so we find the actual balance of that account. Okay? Here's another one. So in this case, we only had one investment, or one number that we're going to add, so we just put it on the right-hand side rather than on the left-hand side. So we have our beginning capital plus our investment. Our subtotal is here. In this case, we have 2 things that we are going to deduct from the equity. In this case, our withdrawals and our net loss. So we have to add those 2 numbers, single underline, our total decrease in capital, because obviously if the owner takes money out and we lost money, our capital has to decrease. So we put that here, which is followed by a single underline. And then so what we're going to do then is subtract. Our ending capital then is $25,391, followed by a double underline. Once again, this amount will be transferred to the balance sheet in the owner equity section. All right. In the balance sheet, sorry for that sound bite. This is just going to show basically the accounting equation, our assets, our liabilities, and our owner equity accounts at the end of the period. These are all our permanent accounts. So it's going to show what our record of our assets and our claims, both the creditors and the owners, against those assets for that specific date. And that's the key, for that specific date. All right? It's also called a position statement. And once all these statements basically are done in ink. Now, I know one of the words that you'll see, the balance sheet is prepared in report form, which means that the classifications are shown one under the other in order. You have your assets, then your liabilities, then your owner equity account. Okay? You take the information in the from the balance sheet section of the worksheet and from the statement of changes in owner's equity. All right, so what you have, once again, name of the company, name of the statement. When is it for? In this case, a specific date, so it's not for the month ended, it's that specific date. You'll notice the classifications are centered. And, all right, I'm back. Somebody walked into the room, but once again, we have our assets, our liabilities, and our owner equity section all centered. Their classifications. You list all the accounts that have balances. And you'll notice column 1, all the balances are listed, single underline, total right here on the right-hand side, followed by a double underline. So remember, our accounting equation, total assets equal liabilities plus owner's equity. These two numbers must equal. If not, you did something wrong. And generally what it is people forget to take this number from the statement of changes in owner's equity and bring it here in this part of the balance sheet. So once again, we have two account payables listed on the left side, single underline total listed on column 2. You don't have to skip a line, as they've done. And then you have the owner equity section, name the capital account. This comes from the statement of changes in owner's equity. Then the last line, total liabilities and owner's equity, and the total followed by a double underline. These two amounts have to match. If they do, your accounting equation's in balance, and you've done the 7 steps of the accounting cycle perfectly. Now, last thing, I don't know if I'm going to have time, ratio analysis. We'll be doing that. The one that's really important is you want to find, what it's going to do is help you compare two different amounts on different statements to see how the company is actually doing. The one I care about is the return on sales. All right, so it's net income divided by sales. So we have, if you have the net income of this, your sales of this is a revenue account, by the way. You have, in this case, it'd be 0.434 or 43.4%, which is awesome, which means each dollar that you sell, 43.4 cents of each dollar, or of each dollar is profit. That's awesome, 43.4%. It's a great profit margin. So all I care about is that you know for return on sales for this unit is net income divided by sales, or the revenue account. And it could be more, but usually it's just the sales or revenue account. Divide the two, gives you a percent, and that's how much you're making for every dollar of profit. And that could, liquidity ratios. I mean, you can look at this, how to figure it out. The current ratio is just, you're looking at the relationship between current assets and current liabilities. And these are their current assets and current liabilities. You want to have a 2-to-1 ratio, 2-to-1 compare assets and your current liabilities. The higher it is, it shows that you can pay off your debts. We're not going to look at the Starbucks one. Just so you have an idea, I've done something in college where I had to compare this for companies, and I'm running out of time. So you might have to look at some of the information in the book near the end. All right. Once again, the one that I really care about is the return on sales, net income divided by sales. All right. I hope everything's going all right. This is it for me. That is Chapter 9. I hope Mr. Jeske is doing a great job. Please practice and be ready for your final. If you have any questions, feel free to email me and let me know. Thanks.